Such a pleasure to welcome all of you to this session at Wide-Moat Investing Summit 2016. Very much looking forward to this session with Richard Cook and Dowe Bynum, who are partners and portfolio managers at Cook and Bynum Capital Management, based in Birmingham, Alabama. They founded the firm in 2001. Prior to founding the firm, Richard was with Tudor Investment Corporation in Greenwich, Connecticut, and Dowe was with Goldman Sachs. I may have a question or two following their remarks. I also want to encourage all of you listening to follow up with any questions with us, and we will be happy to facilitate the introduction. And with that, I'd like to turn it over to you guys for your remarks. Please go ahead.
Thank you, John. We appreciate the opportunity, and we appreciate all the listeners that took the time to listen. Hopefully this story will be one that's of interest and helpful to them. Dowe and I started this firm 15 years ago with the goal of doing absolute value investing. About a little more than 10 years ago, we started expanding our circle of competence outside the U.S. And with the goal of finding places where the information was more asymmetric and where the tailwinds were bigger. And Latin America is a place that we've spent a pretty good bit of time in that effort. And one of the things that we have a preference for being concentrated, but I think that's with the proviso that we believe it's suboptimal to be concentrated in low quality names, but it's actually, if you're going to invest in businesses in a concentrated way, there needs to be a narrow range of outcomes for the business. And we think in order to get comfortable with that, then the business almost always needs to have a deep or wide moat to be eligible in a concentrated portfolio.
Well, we believe that code bottling in Latin America is a deep moat business, and so we'd like to go into a number of the reasons why. First off, a brief history of coke bottling. In 1886, Dr. John Pemberton, who was a pharmacist, began selling his syrup to soda fountains in Atlanta. And in 1899, three Chattanooga businessmen came up with the idea of bottling the product, and they bought the rights for $1. And just to show you how fast bottling expanded, by 1909, there were 400 bottling plants in the United States. And then by the late 1920s, bottling sales actually surpassed soda fountain sales. So that was a pretty quick rise for a bottle to overtake soda fountain. And Coca-Cola also began international expansion into markets like Mexico, which is one of its first international forays. Subsequent to World War II, the bottlers began expanding the types and sizes of packages they sold. Traditionally, Coke had been sold in 6-ounce and 8-ounce bottles. And during this time period, you see larger sizes like 2-liter presentations come into the market. And also there's a proliferation of new brands. So Sprite gets introduced, and many of the other brands that have ended up in Coke's portfolio had their genesis in this era. And moving on to the 1970s and 80s, bottler consolidation begins in earnest. Of course, the road system in the United States, the interstate highway system, wasn't conducive to moving heavy liquids and bottles all over the place. So you had bottlers in every major city and lots of towns. But you started to see economies of scale develop. And currently this is happening in Latin America in a major way, with private bottlers rolling up and being sold to public bottlers and big bottling interests. And the other thing you have is a switch from a focus purely on selling the most volume through the system, which was the original model, to more a partnership model where Coca-Cola and the bottlers are trying to generate the most profits from sales. So that results in selling a lot of different package sizes and things like that, not just trying to ship the most 2 liters out the door.
We want to talk today about the moat that's embedded in the Latin American bottlers, and so to do that, I wanted to give a little bit of talk about the different players. There's been a wave of consolidation in Latin America, as Cal mentioned, and the most important player in that has been Coca-Cola FEMSA. They're based in Mexico City. They bottle in Central America, Colombia, Venezuela, Sao Paulo, Greater Sao Paulo, and in Buenos Aires. And they're I believe with the new deal in Europe, they're the second largest bottler in the world, but it's a big company, and so they're certainly a bottler that is important. And then the second largest bottler is Arca Continental, and we've owned Arca in our portfolio for for about 8 years now. They're based in Monterrey, Mexico, and they bottle northern Mexico, which is the best Coke market in the world on a per capita consumption basis and on a profitability per ounce basis. They also bottle in Ecuador and northern Argentina, and they also are the controlling shareholder of Corporación Lindley, which is the bottler for Peru. Coca-Cola Andina is the third largest bottler in Latin America. They're based in Santiago, Chile. They also bottle parts of Chile, central and southern Argentina, Greater Rio in Brazil, and they bottle Paraguay. And then a smaller bottler, Coca-Cola Imanor, is also a holding of the fund, and they are based in Santiago, but they bottle basically most of Chile outside of Santiago, and they also bottle Bolivia, which is a fast-growing region. On the right side, we listed just a few of the larger private bottlers in Latin America, but there's still a number of private bottlers, and we expect that consolidation amongst them with each other and with the public bottlers to continue over the next 10 years.
So the Coke bottling business's moat in Latin America is really, really deep. And on the next slide, we'll show, here we go, this virtuous cycle of what happens. So number one, you've got dominant brands. Specifically, Pepsi's not nearly as strong in Latin America as it is in the U.S. So that leads to distribution advantages. People want to carry your product. And that leads to higher market share. And this circle goes in both directions, too. By having more market share, you get more clout with the retailers to whom you're distributing, and it helps give your brand a better brand equity. And so there's this virtuous cycle that makes the competition weaker almost every year and strengthens your position every year.
When you think about the brands in the Coca-Cola system, it's, Red Coke or Coca-Cola Classic, as sometimes called in the U.S., is certainly the biggest part of that in Latin America. But it's important to remember that there are 20 brands in the Coca-Cola system that do over $1 billion in sales per year. And most of these are available in Latin America. And they're an important part of what Coca-Cola is doing. And I think it's true that of the 20 brands listed here, 18 of them are available in a reduced calorie, low calorie, or no calorie version. So when you think about the Coca-Cola system, it's important to think beyond just Red Coke. But I think maybe the thing that's the biggest difference between thinking about Coca-Cola and Coca-Cola's brand in the United States and Coca-Cola's brand in Latin America is that Pepsi is really effectively a B brand in Latin America. The brand equity of Pepsi is much weaker, and you'll frequently see Coke selling at a 10 to 25, 30% premium to Pepsi on the shelf. And here's a picture I took in Monterrey, Mexico a couple years ago, and you'll notice the promotion here is, I don't know if you can quite tell, but the promotion is if you buy 2 bags of Frito-Lay chips, they will give you a Pepsi for free. And I think that gives you sort of an indication of what Pepsi's trying to do just to move some volume. So when you think about Coke's moat, it's very important to think about how strong the relative strength of Coke, both in volume and sales, in share, and in share of mind versus Pepsi.
And that brings us to the second part of our virtuous circle, which is the distribution network that happens in Latin America and the market structure. So over 50% of the retail market in Latin America is categorized as informal. So formal, what you think of as traditional supermarkets, hypermarkets like a Walmart in Mexico or a Carrefour or something, discounters, which are not a huge part of the market, but they do exist, whether it's a Sam's Club or something similar, and traditional convenience stores like the OXXO picture or a 7-Eleven. But over 50% of the sales are happening in this informal market, which are small mom-and-pop bodegas. There might be people selling out of a living room when they're between jobs. Roadside stands, or even just a guy with a cooler slung over his shoulder walking through the streets of a town or city selling Cokes to make a few extra dollars. And just by way of example, so in Arca's territory of Mexico, they're about 400,000 points of sale, and if you overlay the revenues on the points of sale, each point of sale would do about $7,500 in revenues per year, which is not a very big number. And if you overlaid the Pepsi distributors' revenues for those same points of sale, they would do less than $1,000 of revenue. And what that tells you, and what we've seen from our research and our travels, is once you get outside the big cities and once you get outside of the urban areas and once you get into the small mom and pops, it becomes increasingly difficult to find Pepsi. Pepsi can't profitably distribute to a huge portion of the informal market, and that's the largest part of the market for soft drink sales.
So when you think about this informal channel that is the majority of your sales, it's if you're big enough, then you can have a captive distribution system, and that affords you a number of advantages. In this picture here, you can see Kime in the red shirt. I was down in Quito in March, and I went on with his boss, which is Phil, and the Northern District Manager, and we graded 10 of his stores on his sales route. And we looked at a number of different initiatives that Arca has to try to get the best performance out of these stores, from whether or not the cooler is placed in first position, is it in the best place to confront you or interrupt you as you walk in the store? What percentage of the cooler space in the store in your category is represented by your products? What are the SKUs that Arca is pushing at that moment that they want to make sure they're not out of stock of, make sure they're available? What's your signage look like? What's your percentage share of visible space outside of coolers within the store, et cetera? There are a whole series of these, and they have basically a report card that they grade you on. And I actually graded Kime at these 10 stores, and with their help, and to make sure I was doing it to match with their initiatives. But if he grades higher than 90, then he gets a bonus. And in this case, he graded about 95 or 96, and so he got a $350 bonus for doing that, which was outstanding, and he was very excited. And you compare, what you can achieve with that set of incentives with a captive distribution to what you see when you're distributed by a third party. This is a picture we took, Dowe took it. We were together in Salta, Argentina a few years ago, and at this small mom and pop, either Pepsi is completely failing on distribution, or they've paid to put a cooler here and then abandoned the store because it was too small and they're no longer distributing there. But either way, they've outlaid $200 or $300 to put this cooler here, and there's no Pepsi available in the store. And if you look carefully in the picture, in the reflection, you can see the Coca-Cola cooler, which is in first position right by the door and right by the cash register, and it's fully stocked, ready to make a sale. And I think that illustrates some of the advantage of having captive distribution versus third-party distribution.
And also the incentives, as Richard mentioned, in terms of being able to grade your own people and have people who care about how the product appears in the stores. Continuing on that same line, on the next page, you'll see a picture of a cooler setup that we took. And this is the kind of cooler setup that would be in a larger mom and pop, even a convenience store type situation. You might see half of this or a quarter of this, and then in a very small mom and pop. But what Coke's doing is they're providing all their offerings in a cold setting, and when you put a cooler in a store, you basically triple the sales of your beverages. So frequently what you have is every variety of Coca-Cola product available cold versus, especially in the informal market, a hot Pepsi or a hot other B brand available on a shelf. And so it makes the decision to choose Coca-Cola that much easier for the consumer.
Yeah, we talked, there are many aspects of what we call execution at the point of sale and things we look at when we get out in the market. But I mentioned primary position or first position earlier, and this is an example of that. You walk in this store, the first thing you run into is a Coke cooler that's well stocked. But notice what else they've done. They've because Coke is so important to this mom and pop, typically Coca-Cola and the local brewer will be the two most important distributors from mom and pop. And they've used that position to also put these two hot stands next to it. So you have some familial sizes and what we call the second and third position. So they're serving as, a place to sell a product, they're also serving as sort of a billboard for what's in the cooler. And they're also pushing the Pepsi cooler or hot Pepsi, or however it was, I've forgotten exactly what it was in the store, down the line. So they're really, the Pepsi cooler is no higher than fourth position in the store. And those types of advantages, as they accrue, can really make a difference in preserving your position, the brand's position in people's mind. Another important advantage of having the scale that Coke has is you can afford to do a returnable operation. So in most markets in Latin America, you will find returnable sizes is an important part of what they're doing. And here you see on the far right, you have a 2-liter returnable bottle. So and they use price bracketing around this. And what they do is if you walk in the store with 18 Mexican pesos, for example, and you want to buy cola, well, you have a choice between buying a frequently hot 2-liter non-returnable Pepsi, or if that volume is most important to you, you could switch to the 2-liter returnable at the same price point. But because they're reusing the packaging, they've got higher margins on that. You can reuse the returnable packaging typically 10 to 12 times. Or if not having to return the product is important to you in your particular use case, you could buy a 1.5-liter non-returnable for 18 pesos. But either way, you bracketed this customer's decision so he never has to choose the B brand. He just sticks with you. And you also have better margins in both your presentations than they do.
And one other quick point about the returnable business is when you have the skill to run the returnable business, if you decide to do the 2-liter returnable Coke for 18 Mexican pesos that's in this picture, and you return the bottle, Coke is benefiting from your labor, but also you don't have to take a 2-liter Coke the next time. And frequently you can take a 2-liter Fanta, a 2-liter Sprite, or any of the other Coke flavors. So the breadth of product offering available locks you in more and more to that system. And so this next slide here is kind of the culmination slide of the original virtuous circle, which is how the brand and distribution execution look in the market. And per our research, and these are really rough estimates, the Coke bottling business has about 65% share by volume in Latin America. Now that's as high as 75 to 80% in the best markets in Mexico and lower in other places that are poorer, where the system is a little less developed. But that's a pretty staggering number. And when you move on to value share, which is based on revenue, we estimate about 73% of the value share accrues to the Coke bottlers, and a lot of that's due to the fact that there's a higher average selling price, as Richard mentioned before. In most markets, almost all markets that we've seen, Coke sells at a premium to Pepsi and all the other B brands. And then that translates into something like, again, very rough estimates, 78% profit share, as you've got the higher margins on the returnables and the higher price per ounce because of the higher prices that you're able to charge relative to the B brands. And we look at the small slice of the pie that's left over for the competitors, maybe only half that's Pepsi. There's some fairly strong B brands that compete very hard with Pepsi, but there's not a lot of profit to go around for those people. And so this virtuous circle tends to accrue to the Coke system's benefit. And just returning to that slide, the dominant brands give you these distribution advantages that we've shown in the pictures and discussed previously, which leads to increased market share. But this works the other way to dig the moat deeper too. So if you increase market share and distribution advantages of captive distribution and coolers, it also helps to reinforce your brand and give you more and more brand equity as Pepsi and other brands get squeezed out of channels that they can't afford to compete in.
And we wanted to take just a minute to talk about just some examples, some creative examples of things that Arca is doing in some of their markets. We've talked about how important this informal channel is and this fragmented market is to preserving the moat. And one example of that is an effort that Arca is making to preserve the informal market is what they're doing, we call the 21st Century Program, where they want to make their best mom and pop owners more competitive at running their stores, so hopefully they can resist being the competition from the formal market. So they'll actually started basically a university program where, it's not that expensive, but a program where the owner of a store could come in and learn a set of skills, not just about selling Coke, but also about selling bread, selling milk, where to put the cash register, how to light the store, and things like that. And that'll make him more profitable. It also makes him more loyal to Coke because now he's making more money. So he's going to be more loyal to Coke and to Arca in future transactions. You can see here on the picture is 3 certificates of completion for Miguel, who ran a mom and pop I went into a couple of years ago. And he had proudly displayed by the cash register. And if you, in return for completing the program, Coca-Cola will invest some money in what's really the bottler. Arca Continental will invest some money in improving the look of your store. They call it painting it red. And literally these guys are painting the store white and red. So, and they put in a new awning and they put a series of signs and decals on the walls, all to serve as a billboard within the community, but also to make this the guy that owns this store more agreeable, more attractive for someone to walk into. And if you look, we talked about first position a little bit. You look on the right there, the cooler is placed in first position for this store as well.
Yeah, another area where having scale allows you to innovate quickly is illustrated by this next slide, which was something we discovered when Arca first bought their Argentine business. There was a local B brand that commanded about 7% of the local CSD market, an apple-flavored soft drink. So Arca, in conjunction with Coca-Cola in the United States, very quickly developed a Fanta apple that tasted similar to this drink. And within about 3 months of its being introduced in the Argentine market, they had taken 70% share from this company. So not only did they pick up a nice amount of market share for themselves and profits in a category that they didn't even compete in when they arrived in the market, you have to remember that this other company's business shrunk by 70% in those 3 months. And they were also the producer of some other lesser brands. So now this company that used to have 7% market share of this carbonated soft drink market ends up with, call it 1.5%, 2% of the market, and they have that much less revenue and profit to invest in distribution. So it's almost like a snake, just slowly squeezing the competitors out.
Another thing that Arca did in 2007 is that they bought a small snack food brand salty snack food brand in Mexico called Bocados, and they've been expanding that throughout Mexico and even doing some sales outside of Mexico. But they figure what we're good at is having this relationship with the mom and pop, and we understand this informal channel. How else can we expand that? So they do some cross-selling. The same salesman can sell Bocados when he goes by to visit a particular mom and pop twice a week. And they deliberately try to pick categories where they're not competing against strong Frito-Lay or strong Grupo Bimbo in that category, and it's been a successful effort. So if you think about what's Coca-Cola's runway, one of the trends that we've noticed is that about $5,000 per capita GDP, and going on consistently till about $20,000 per capita GDP, people want to switch to ready-to-drink products because anything is packaged in a can or a bottle. If you look at the picture here, this is in I took this picture when we were in Santa Cruz, Bolivia, a couple years ago, and this is typical to see fresh juices being squeezed in a manual way on the side of the road in a cart. Or another thing that's real common in this part of Bolivia is just putting some lemon juice in the water. It's not really lemonade, it's just lemon juice to make the local water taste better. But as people start reaching $5,000, $6,000, $7,000 per capita GDP, they start switching away from these choices and buying prepackaged orange juice or Coca-Cola in a can or water in a bottle, etc., or beer in a bottle. The same characteristics were accrued to the brewer, but the switch to ready to drink, I think, is an important tailwind for the Coca-Cola system in many places in Latin America and many places in emerging markets around the world.
And this also often happens with the wealth effect because in a lot of places the water isn't safe to drink everywhere, and the places are frequently arid, and if it's Mexico and down at the equator, very hot. So switching to ready to drink makes a lot of sense. Also tying into this is if you look at this chart of the per capita GDP and the median age, there's a long runway for some of these poor countries to get up, and we think they're going to have relatively fast GDP growth compared to most of the world. And even with the median age of the population in these places, as those people start to age up and earn more income, they're going to have more disposable income to put towards consumer products. I mean, when your per capita income goes from $6,000 to $7,000, you're not able to run out and buy a new car, but you do buy more Coca-Colas, more Coca-Colas and more razor blades and branded shampoo and things like that. So there's a lot of room for growth in these markets.
All right, John. I hope that's been helpful, and wondered if you might have any questions that we could clarify the thoughts.
Absolutely. Well, thank you so much to both of you for the in-depth remarks, and really appreciate the on-the-ground intelligence that you were able to provide. A question perhaps on how you think about the long-term growth rate here. Penetration is obviously pretty high already. Maybe there's some room for market share gains, but how do you think overall about the growth of the market?
Well, I mean, the United States, you have per capita consumption in the 400s of Coca-Cola products. In Mexico, in northern Mexico, in Arca territory, it's about 720, which is the best market in the world.
That's 8-ounce servings per person
per year. Yeah, sorry. But you see numbers 250 and below in most of the poorer countries in Latin America. So I think that reaching at least what the consumption is in the U.S. is certainly practical. I think the other thing to think about is if you think about the Coca-Cola system globally, it's about 2 billion servings per day. But humans consume about 25 billion servings per day. So of liquid. So what are the other categories where it makes sense for Coke to participate? And I think basically anything that's ready to drink is within that. And you're actually seeing some important initiatives. I mean, Jugos de Valle is a fruit juice brand that's now was started in Mexico, is now throughout Latin America and growing. It's been very successful for Coca-Cola. They're also doing Arca is in a partnership with the Coca-Cola Company and Tony Corp, which is a value-added dairy business in Ecuador. And I visited their plant back in March when I was down there. But they have about 75% share in Ecuador in value-added dairy. And I think that that's a category where, the relationship with the mom and pop, the relationship with the informal market is important, where brand equity is important. And I think it's one that Coca-Cola, the Coca-Cola bottlers and the Coca-Cola Company can be successful. So I think what we'll see going forward is increased innovation around other products, to try to go from 2 billion to 25 billion. But I think, but this switch to ready to drink, even if none of that happens, this switch to ready to drink over the next 20 years will continue to provide plenty of growth in this region.
And could you elaborate a bit on valuation and how you would think about valuing this kind of business? What do you think is a fair free cash flow yield, or any metric that you consider to be important?
Sure. I mean, where you see these, where you see these things trade is around 9.5 to 10 times EBITDA. I'm always a little uncomfortable with EBITDA margins as justification for valuation, but that's just sort of where they've been traded internally in the Coca-Cola system. I think it depends a little bit on the country. It depends on how good the operators are. But we would probably somewhere certainly in the low to mid-teens. I think these businesses are PEs. These businesses are attractive as long as there are not some significant adjustments you need to do to the accounting.
Yes, and the good operators are very adept at, if they use debt to buy a bottler, a private bottler, they very quickly pay it down to be in a position to make the next acquisition. Everybody wants to be in the prime position to get the phone call from Coca-Cola or from the private bottler when somebody's looking to make a transaction.
When we originally bought Arca in 2008, we paid 7 times earnings for for a double-digit grower with a 9% dividend yield and net debt less than 1 year's EBITDA. So, we would love for that type of valuation situation to recur. That would be very attractive, but unfortunately, Arca has appreciated substantially, and it's probably not that attractive at the current prices. But if we catch a cold in the United States, sometimes they catch the flu in Latin America, and you can get some very nice valuation opportunities.
Speaking of valuation opportunities, there are obviously quite a number of publicly traded entities related to the Coca-Cola system. Could you give us just a little bit of background on kind of how you think about the relative attractiveness of those? Do you look at the geographies? Do you look at maybe slight differences in business models? How would you kind of go about if you take the whole Coca-Cola universe and kind of narrowing that down?
Sure. Yeah, we spent a fair amount of time thinking about the different public bottlers around the world. We look at, what are current per capita? What's current per capita consumption? What's current per capita GDP? We look at the execution at the point of sale, how effective or is the bottler at what they're doing. We look at, certainly at the valuation. If you look at the landscape a little bit, Coca-Cola Consolidated is the only public bottler in the U.S. This tie-up in Western Europe between Coca-Cola Iberia, the German Coca-Cola bottler, and Coca-Cola Enterprise is probably, is representative of a fairly mature market in Western Europe. Now in Switzerland, but originally in Greece, Coca-Cola Hellenic, or HBC, I think is their new name, is they have better demographics, I think. I mean, they have Nigeria is about 10 or 12% of their business. I'm trying to remember off the top of my head. Russia is an important market for theirs. Greece, Eastern Europe, Italy, Austria, Ireland.
Yeah, they've got some issues though, just in terms of demographics. I mean, much older populations and a colder climate, which affects them. Then you've got Coca-Cola Tech, which I can't ever say the word right, but the one that's based in Turkey, that has really favorable demographics. They distributed most of the Arab world and the Middle East, really young populations, but they struggle, of course, with the rule of law and all the stuff going on there. There's probably a really long runway for them, but it's far more. So.
Yeah, they probably have the best demographics of any bottler in the world, Coca-Cola Tech. But, the Pakistan is their second largest market, for example. 200 million people in Pakistan, per capita consumption is 2 or 3. Pepsi's number 1 there, but they've demonstrated in Turkey, which is their home market, that they've been able to take, go from a minority position to a majority position. The private bottler that's in Egypt has done something similar. So I think that there used to be a preference against Coke in the Mideast because Coke was considered American, although Pepsi, which was started in North Carolina, was not considered American for some strange reason. But I think there are opportunities there. Coca-Cola Amatil is another interesting bottler. They bottle Australia, New Zealand, and Indonesia. And we're certainly interested in the Indonesian market, but it's one that they've struggled in. We spent some time with Amatil, and we also spent some time with Ahi Group, which is a B brand operator that started in Peru, that's now based in Madrid. And they've been able to take substantial share in Indonesia just by opening a plant and starting to sell their B brand around the plant, which I think speaks to the quality of the execution in Indonesia. And actually, the Coca-Cola Company has gone back in there in the last year to try to reinvest and improve the outlook in Indonesia.
Yeah, I mean, worldwide the bottling system is strong, and I think it's strong because it's in, a lot of publicly traded hands and in private hands in places. It's different than the blue system, and we think in a better way. But Latin America, we think it's by far the most promising in terms of execution and opportunities.
Yeah, I think you will see in Africa over the next 30 years a similar type of consolidation and opportunity. But it's really not, you can't play it yet. But we certainly think about per capita income, per capita consumption, the temperature, the percentage that's ready to drink, and those types of factors. We think about what's the long-term growth rate for a potential for a region. And then, of course, you got to look at the actual execution of whoever the operator is.
Wonderful. Well, thank you very much. We'll leave it there for now. I'll just remind everyone listening in, if you have any other follow-up questions, feel free to contact us or post a question in our online community on Slack, and we'll be happy to pass it on to Richard and Dowe. And with that, guys, thank you again so very much for being with us and for presenting this compelling business to our